Now we're continuing to talk here about break-even analysis and operating leverage. And we've been running through a little example here where we had fixed cost of $60,000, price per unit is $50, the variable cost per unit is $20. We calculated the break-even point, the operating break-even, and it gave us 2,000 units. I showed you how you really don't want to operate there because you'd be left with zero operating profit. And if you have any interest on your debt, this is going to be a bad idea. What I showed you also is how we adjust this. We add to the numerator here our desired level of EBIT, divide that by our price minus variable cost per unit, and what we got in the last video now was 6,619 units. Indeed, if we produce and sell 6,619 units, and we sell each of those at $50 a piece, our sales, our revenue is going to be $330,950. Price per unit is 50, the number of units, 6,619. To get total variable cost, we take the variable cost per unit, which in this case is $20, multiplied by the number of units we produce and sell, which is 6,619, and you get total variable cost of $132,380. We also have fixed cost of $60,000. So if you take revenue less your variable cost less your fixed cost, you're left with an operating profit now of $138,570. From that, we would subtract the interest we owe to the bank, our interest expense, and that would give us taxable income of $128,570. The government, the state, and the Fed is going to take about 30% of our income. 30% is $38,571 in taxes that we owe, and that's going to leave us with exactly $90,000. Indeed, we have a dollar's worth of rounding error here, but as you can see in this proof here, the little adjustment that we make to the break-even point formula, that's the adjustment that we need to do in order to achieve the operating profit that we need to pay the interest on our debt, to pay the taxes we owe the government, and to be left with exactly the amount of money that we need to pay the other expenses, the after-tax expenses of the business.